Welcome to Subramani. Um, should you be worried about the volatility in the markets? Yes, of course you should be worried because you do not know where the market is headed. And there are experts like Naren saying, he's been saying it for the last say 8 months or 9 months or maybe 1 year, that the markets are not going anywhere for 2 years. So 1 year may be over. So another 1 year maybe the market will go nowhere. There's enough evidence to also believe that during election year there's not likely to be much of policy action, but some actions, some policy actions of the past like creating good infrastructure etc will definitely start giving good results. That will happen, but something new may not come, something big cannot come from the macro. Are you expecting anything great from the government in the next 1 year during the election year? Not really. Maybe some subsidies might increase or things like that, so some spending at the bottom of the pyramid could happen, but not really much one should expect. So what should you do when markets are volatile? First of all, have a plan. If you are a direct equity buyer, then maybe you should identify companies which you want to buy at a particular price. Don't get carried away by the recency effect. For example, Adani Group shares have definitely fallen. There is no doubt about that. So let me take an example of say Patanjali. Patanjali was 1400 when the Adani bad news came or something came about the Adani share, and people thought it is worth selling, and that is the time when the Patanjali share was for 1400. Patanjali shares have fallen since then, fallen to say 900, 898 or something it closed at. So about say from its peak it has fallen by 33%, one third. Therefore it is a good buy, right? No, not necessary, because even now the PE is something like 35. Do you want to give PE of 35 to a company with no great track record in the public life, right? So yes, it has had a private company, it was a private company. You cannot take the history of Ruchi Soya and compare. This is a completely different company from Ruchi Soya. So therefore create your own strategy. You say, okay, I will buy Patanjali only at a PE of 25 or 30 or 35, whatever. You choose the PE at which you want to buy and wait till that price. Don't buy a share just because it has fallen. So you should have a plan that you are investing in which kind of equity. If you are a mutual fund investor, then you really have to do nothing. I just continue your SIPs, saying okay, maybe it will take 2 years for the market to revive, but I will continue my SIPs. The other way to look at it is to say 2 years I'll keep money in some other fund, and after 2 years I will come back into the equity market. It's very difficult for most of us to do. Therefore, during volatile times, maybe you increase the amount of money that you put in a balance advantage fund instead of in an equity fund. Let's say you're doing a 10,000 rupee SIP in an equity fund and a 10,000 rupee equity in a balance advantage fund. Stop the equity fund SIP and double the balance advantage fund SIP. Obviously, you're going to get suboptimal results if the market shoots up, but at that time you can always restart your SIP in equity fund. Otherwise, if you're very clear that you have a 5-year, 10-year view, and you don't you will not worry about about watching television or watching videos which say, oh, now you should come in, get out and things like that. Just continue your SIP. But for individual equity investors, it's very important to realize that don't get carried away by a fall. The rise may have been spectacular. I remember the price of Sun Pharma going up from something like 300, 350 to 1200, and then people saying, oh, it's a great buy, it is worth keeping. Yes, of course it is a great buy, it is worth keeping, but it is a great buy now at 600, 700, 900 rather than at 1200, and if you're held on for the last 5-6 years, you could have got terrible returns. So don't get carried away. Have your plan, know why you're investing in equities, use volatility to buy. So right, that's why you should have a plan. Predefine some of your actions, saying at this price I'm a seller, at this price I'm a buyer. Pick up some 10 shares which you have in your portfolio and say at this price I'm a seller and pick up 10 shares which you say I don't have it in my portfolio, but if the price falls below this I'm going to buy. Stick to it, right? So for me that price is something like 320 in case of say Ambuja Cement. I'm happy to buy Ambuja Cement at 320. So I bought at 320, but when it reached 420 very quickly, 415 or 416, It was a fantastic price for me to exit. Then when it came back, I could buy it again. So decide, I was definitely an investor in Ambuja Cement. I had no intentions of selling it because I used it as an opportunity when that Hindenburg report hit, and I used it to buy Ambuja Cement. I also bought some Adani ports, but I've got out of Adani ports. I still think it is overpriced, right? So it's not the business which is a problem, it's the valuation which is a problem. So a volatile market allows you to do that. So first of all, you have a plan. Second, predefine some of your actions, saying these are the companies which I would like to buy. I would like to buy, for example, I would like to buy Reliance at 1999, right? At about 2000 rupees, I think Reliance is a good buy. Am I a buyer at 2200? Maybe a small amount. I'm not in a great hurry to buy, but at 2000 I'm definitely a bigger buyer. Why am I buying Reliance at that price? I do think the IPO of Jio, IPO of Reliance Retail, etc. will come, and that will make that will increase the value, because the PE that the Reliance Retail and Jio will get would be much higher than the PE which Reliance itself enjoys. So that will make more, that will put more cash into the hands of Reliance, which could perhaps go into Reliance Solar or things like that. So therefore, right, so have your plan, execute your plan, make sure that you sit tight. My broker has not been allowing me to buy for a very long time. He's saying the market is just not moving. So I've been trading, yes. So don't think that I have not been, I have been trading, but I have not been investing. I just don't find enough attractiveness in price to become an investor. Of course, things like Coal India you can always buy to get the dividend, but then I don't see any great upside movement. So when Coal India is available at 2002, 2003, I'm a buyer. At 200 and 235, I could be a seller, right? So some of the trading opportunities do exist, but yeah, it's not a great market to be investing. Markets may be more volatile, but you should never worry about the markets or the index. Look at the shares in which you are interested, right? So therefore, it could also happen that you might just might in some shares buy when others are selling and sell when others are buying. You might just do it. It is an accident, though it is a fantastic thing which to say that buy when others are selling and sell when others are buying. To actually implement it is very difficult, but if you make your own rules and plan, you might be able to do it. So some of these things, if you can do, also remember that you will never get your investments perfectly right? So I've always said this, how to avoid polio, take a vaccination. How to create wealth, there is no one single answer. There are very many answers. How to create wealth in equity, there are millions of answers. Do you need to invest in international funds? Do you not need to invest? What should you do? Again, very difficult to answer. We will never get our asset allocation perfect. We will never get our timing right with all shares. Sometimes you'll get it right. Sometimes I'll keep buying some shares, saying, okay, this share is worth buying. There are 2 shares which I am accumulating over for the next 10 years, which are, I can share it with you. It is Zomato and Indigo. Though both are not currently making any money. Both, I think, will over a period of time establish, but 2 years later, 3 years later, if the movement is not towards building market share, I might just dump those shares and move on. If some competition comes for Zomato, it's going to hurt. Tata's buying so many aircrafts, it's a bad signal for Indigo as a shareholder, but I hope that the services improve from both the airlines, right? Some of these things, so you keep having a plan, keep implementing it, keep changing it, keep scrapping it, keep coming out with new plan. This is the only way to handle volatility. Build your portfolio slowly, decide what is good for you and do it. Thank you.